Good morning and welcome back to Almus Market Mornings. Let's debrief on the Federal Reserve interest rate decision. Now, during yesterday's podcast, we had shared on the divided pricing by markets, large names calling for rate hikes, JK's own view of rates remaining unchanged and possibility of descents. And now, what has materialized is, of course, the Fed keeping the rates unchanged with some dissents favoring a rate hike. As usual, the statement was short. But what I found interesting is a question posed to Chair Warsh as to why a rate hike didn't happen this meeting. And his reasoning was that this is because market rates have climbed and the markets have done the job for the Fed. Now, one of the reasons market rates have climbed is, of course, geopolitics. And yes, it's again back on. US and Iran have bombed each other, and it's increasingly seeming the conflict is expanding. Good morning, JK. What's your key takeaways from the Fed's meeting? Because to me, it seems that what Warsh said, even though there's no forward guidance, he used market's own tightening to avoid a rate hike.
Good morning, Swaraj. Yes, in a way, Fed meeting was uh, almost a non-event because rates remained unchanged, and it was no different from June meeting because there was no forward guidance, and apart from a couple of points which Warsh made in his press conference, we got nothing new. And yeah, I get a feeling that these points also could well have been included in the Fed statement, so we could have actually done away with press conference. So actually, I don't see the press conference relevance, because when you have a conference, you are actually normally trying to convey a deeper insight into what the Fed thinks, and that is not available. And whatever he said was same thing as what he said in June. Only 2 points he made was that the market had already tightened the financial conditions. He was happy about that, and which means that he's actually defending Fed's non-action, although he says that inflation remained above target for 63 months. Questionable, of course, if that is so, why Fed is not acting, and why it is not even indicating that it is going to act. So that is one thing. Secondly, on what guidance they take in considering inflation, or what factor they consider. PCE inflation, he said PCE, a core PCE is one thing, and there are a few other factors that he considers as guiding forces for Fed's decision. So apart from that, we got nothing more from chairman, and I think that's where some disappointment was there. But then we are in a new regime, so this is how it is going to be. He talked about the task forces, completing their job in a few months, and then in a couple of weeks, he will be talking to them as well. Let us see if Fed's approach is going to be something new in the coming months in terms of action. So as of now, there is no action by the Fed, and that's where market probably disappointed. But actually, while there was no message to chew upon from Fed, market sent a lot of message. In the sense, we had the long-term yields rise a lot, and two-year yield, of course, stayed almost close to where it was before the meeting. In other words, we had a bear steepening. Now, what bear steepening means is that long-term yields like 10-year and 30-year yield rise a lot more, and the near-term yields don't rise much. Yesterday, for example, 10-year rose to 4.68%, which is 3 points shy of the cycle high, which was seen last in 2008. And 30 years actually rose to 5.22, the highest in 18 years, even higher than what it was seen in 2008. So when this is happening, what the signal that the market is sending is that there is a higher inflation expectations going forward. There is a larger government borrowing needs. There is a concern about fiscal sustainability. Investors are demanding a higher premium because eventually Fed will have to raise rates. That's a fear. You see, they may have to raise rates much more than what they're compared to their inaction right now. And stronger than expected economic growth also might be one of the causes. But this is what the message. So we're getting a lot more message from the bond market action than from Kevin Warsh, and that is significant. So now that the yields have broken into new high, particularly in the long end, like 30-year, we have to really see how it further impacts, because already we have seen an impact on the stock market. All the three indices, Dow 2.19%, S&P 1.52%, Nasdaq 1.74%, just 1% away from getting into the correction territory. All a lot of concern about chip stocks, taking cues from other markets like Korea and Taiwan. And Fed's inaction in the face of higher inflation is also something that the markets are concerned about, because again the fear is that going forward either the yields will rise substantially or Fed will get into a sudden burst of a series of rate hikes. That's the fear for the market. And also another fear is that China fears have been heating up, both in the race to develop advanced chips as well as Chinese firms rolling out cheaper AI models. So bond market sell off and then the stock market sell off. This is the main reaction. Of course, dollar also got sold off a bit. I would say significantly, because it had been ranging in a very narrow range. Now suddenly euro was up above 1.1470 from low of 1.1370 seen. Even the dollar yen, instead of following up on its up move above 164, it has actually come to low 163s. There was sell-off in other markets as well, or other currency, dollar against other currencies as well. Even significantly gold and silver rose, quite a bit, about 3 to 4% after the Fed rate decision. So all in all, there is a dovish development in the market for the dollar. So dollar has taken it on the chin. Bond markets have got sold off. Stocks have got sold off. So it's all across selling that has happened as from the point of view of US markets. Now, of course, market awaits the GDP. First look at the GDP for second quarter. That will be announced today. And then the PCE inflation data, because PCE inflation data will be for June, and June CPI, PPI were lower. So PCE may well show a lower, but again, the market unlikely to react much to a lower number, because since that data in July, we have seen the oil price rise again, and it's ongoing. As you said, the Iran-US standoff is still ongoing, and there have been attacks by on US forces in Jordan, and there is a rejection of Oman's proposal to share control of Strait of Hormuz, and then US has vowed to react very strongly as well. Oil has risen to $90. So there is no relief from those also. So in this context, I think markets have a lot to look beyond the PCE inflation number and the GDP number. And I think I'm again very focused on what happens to the bond market, because let's not forget the core issue that the US economy is facing. It's not just the inflation, it is the fiscal deficit and the rising government debt, which is now pushing above 40 trillion. So that's going to be a big thing going forward into the market, and yields are going to give you the forward guidance as far as that is concerned. In the meantime, a picture of stability, rupee for a change, staying well below 95.70 for more than two sessions now, and it's significant even in the face of month-end settlement both in the OTC and the futures market. We have not seen recently rupee holding firm like this. And of course, the large intervention by RBI, along with data indicating healthy flow for FCNR scheme, has managed to keep the sentiment somewhat improved. I would say this is a short-term relief for the rupee market, and medium term, of course, we have to see a lot more positive development in terms of FDI flows, which are long-term in nature, and foreign investors return to stock markets as well. So until those things happen, I don't see a very big rally in the rupee. Might well be between 95 and 96 half, with a lot of help from RBI as well. So I think even significant that oil rising 7% did not influence the rupee much yesterday. So let's see. I think the stability may be there for some more time until some new development happens in the bond market or in the oil front. Thank you.
Thank you, Jakan. Yes, I think markets are now looking well beyond the GDP and the PCE data. There's a lot of attention on the bond markets, as you can mention. The long-term yields, they are rising more than the near-term yields. Where steepening is happening, and it's of course impacting equity somewhat. But this it has to be seen with a lot of attention, because it's a concerning development. Generally, bond markets are expecting that the inflation will remain elevated, and um, it's interesting that with the rates, market implied rates going higher, Fed has used that sort of as a justification to not hike in this meeting. So that, again, a new statement which we saw from otherwise somewhat recycled statements from the June meeting. So a lot of things to watch out for. Of course, geopolitics is also flaring up now. The entire conflict is widening, and amidst all of this, now rupee has stayed quite firm, trading below 95.70. And that's even in the face of month-end settlements, it's holding firm. So it's surprising. So a bit of a more positive sentiment for rupee, and that's how it looks like we might end the week tomorrow. That's it from us today. Thanks for listening. We will catch up tomorrow with a fresh round of updates.